Hey everybody, I'm Christopher Green. You're watching AMTV, Alternative Media Television. I am with co-host today, Marco Santarelli of Narada Real Estate Investments, here to talk about the how-tos of real estate investing, what we can expect in the future post this train wreck that makes up the U.S. election today. You see, it doesn't really matter who gets into the White House. We need to ask ourselves, what's going to happen to this economy? What's going to happen to the stock market? What's going to happen to real estate? What's going to happen with interest rates? You know, there's been a big debate for a very long time. There's people in the inflation camp and there's people in the deflation camp. I kind of think we get a little bit of both. But what we're seeing from the Federal Reserve right now, and we're starting to see hints of this through the mainstream media, through CNBC, they're hinting that, you know, we're kind of not really going to ever raise interest rates. In fact, they might even go negative, like Europe. So we're seeing this around the world, and you've got to ask, okay, well, what does this mean? Where do we go from here? If we enter an inflationary event in this country, what does it mean, for example, let's look at real estate specifically with Marco today. Marco, thank you for coming on the show.
Thank you, Christopher. Good to be here.
So what is your view? Inflation versus deflation? Are you in one camp? Do you think we've got a little bit of both? What do you think, and how does this affect real estate? Let's say they continue to keep interest rates super low. We're essentially at zero. Maybe they even go negative like Europe. That, in my eyes, correct me if I'm wrong, is an inflationary event. Would we expect prices in housing, for example, to rise?
We're going to see prices in real estate to continue to rise because we have historically low interest rates, and that just puts upward pressure on real estate prices across the country. To your first, we in an inflationary or deflationary environment? We're, from what I can tell, in a mild inflationary environment, and that will probably continue for a while. If the so-called, crap hits the fan situation were to arise, and I think that's a matter of when, not if, because we've got central banks around the world just printing or creating oodles of new currency and putting that into the system. However, not to digress too much, that is in the system, but it's in the banking system. It's on the balance sheet of the central banks. It's on the balance sheet of large investment banks. So it's really not in the general economy yet. Were that to happen, what would happen is we would see massive inflation. We would see inflation go sky high. I don't know if I would call it hyperinflation just yet, but my prediction, and I agree with other economists and experts out there like Mike Maloney and whatnot, that we'll probably see a very short-lived deflationary period of time right before, kind of like that last gasp before we see a strong a strong inflationary environment. So inflation is coming, and I think your listeners should prepare for that and defend themselves, which is a subject we can talk about later.
Yeah, so really interesting. You mentioned, I thought, kind of a very, really a hardcore truth. So basically, the Federal Reserve has been printing all this money, putting it into circulation, but it's really on the balance sheets of the central banks, and it's been put in the hands, of course, into the the banker class. And I would argue that's one of the reasons why we've seen this upward trajectory in stocks and these kinds of things. And I guess the question that it made me think about, is it in the hands of the consumer yet? Right? Like, is it in the hands of the average John and Jane on the street? We saw this with the last real estate bubble, where people began to tap their equity in their homes. They take out these HELOCs. They've got 1-2 mortgages on their house, and then they keep compounding that process, and they're buying boats and cars and SUVs. And then we started to run into some problems. Do you think that we're seeing any of that now? Like, is the cash in the hands of the consumer, or are we going to get there at some point in the future as we continue to see more inflation and real estate prices rise and this kind of thing? Like, what are your thoughts?
I don't think we're as flush with cash as we were back in 2007 before the housing market crashed. It's people are not using their homes as ATM machines like they were before. There is still a lot of consumerism in this country. 70% of our economy, at least this was the last statistic I read, 70% of our economy is based on consumer spending. We are not a manufacturing company. A lot of that, Trump is right, has been offshored. It's gone to Mexico and China, and I don't fault that for happening, of course, because we do live in a global economy, and that will happen. It has to happen. Businesses will always seek the best cost reduction strategies that they can to maximize profit. So if they can't do it here, they're going to do it elsewhere. But people are not as flush with cash today as they were back in 05, 06, 07 when they used their homes and properties as ATM machines, and they were constantly doing cash out refis, pulling money out, and then spending it on your boats, cars, vacations. The smart people actually redeployed that into other assets, whether it was the stock market, real estate, gold and silver. So I think that answers your question.
Yeah.
But let's keep in mind one thing here, that over the last 2 or 3 decades, the median household income has been relatively flat. Depending on whose study and statistics you read, you can show that the median household income, middle America, the middle class, has been squeezed and shrunk because in real dollar terms, their income has actually stayed flat or stagnant or has declined. So their purchasing power has not kept up with even mild inflation, 1% to 2%. It has not kept up. So the middle class is slowly shrinking. It's suffering a slow death.
Mm-hmm. Yeah, Steve Wynn actually spoke to this earlier this morning. I caught an article where he was saying, he's got thousands of employees, obviously, which they provide health care to. But all that's happened, like through Obamacare, for example, is costs have gone up and they're essentially getting the same product or a worse product than they had before. And one thing that he wanted to see, I actually agree with Mr. Wynn, is that there wasn't a lot of talk about the economy, during the last debate and what it really means when you've got a Federal Reserve printing money and basically the dollars in your pocket aren't worth what they used to be worth. We've heard people say things like it's a silent tax, so it's really pinched, I would say, kind of destroyed the consumer a little bit. And, I've always said in years past where we've seen kind of an eradication of the middle class. Now, you brought up the point, smart people weren't cashing out, investing in vacations and boats and these kinds of things, at the top of the market, years before this, 08, 09 crisis. They were actually, making sound investments, looking for new opportunities, diversifying what they had. We hear don't put all your eggs in one basket. So let's talk about real estate specifically. I have a finance background. Stocks and, the stock market was always, more of my game. A lot of people don't understand real estate as well as they would like to. They hear people making money, making sound investments, but they don't really know the how to. Like, how do you get started looking for properties or working with someone like yourself and finding these, new opportunities where you're taking action today and investing in your future?
Well, first of all, if there's anything I say politically, economically, financially that you want to challenge or disagree with or push back on, do it. Let's debate that. I think a lot of things we do agree on. Before I answer the real estate question, let me comment on the inflation thing that you were talking about. Inflation, most people don't understand it, unfortunately. The media certainly doesn't talk about it other than the fact that the Federal Reserve is trying to achieve a target rate of 2%. Which they have to do. They have to keep our economy in an inflationary environment because the thing they fear the most is deflation. Deflation would destroy this country. It would destroy our economy. It would put us in a downward spiral. Inflation is a stealth tax. It really is. It just takes away from everybody, but it hurts the poor and middle class the most because the dollars that you make, the dollars that you save are being destroyed. The purchasing power is diminished year after year. Our dollar back in 1913 being worth $1 back then has been eroded to anywhere from 2 to 5 cents today. So we've lost a tremendous amount of purchasing power. Now the dollar's still the dollar, but what you see is that 5-cent candy is now a $2 chocolate bar. And so that's the effect of inflation. So the middle class particularly has to protect themselves, and this is where assets come in, like real estate, investment real estate, or income real estate. But let me step back here. I look at investing. When I look at investing, I look at it as having three buckets. For me, this is my personal investment strategy and how I invest. My first bucket is what I'll call precious metals, particularly gold and silver. The second bucket are paper assets like stocks, bonds, mutual funds, index funds, ETFs, that kind of stuff. I'm not a big fan of paper assets. However, I do play the market, and I emphasize the word play the market in the sense that I will take a contrarian approach. If I feel that the market is overextended or overvalued, I may take put options out on the market to take advantage of short-term pullbacks or position myself for a correction or a crash. That third bucket, which is my favorite, is rental real estate, income real estate, which is a hard asset. We have to remember what real estate is. They're commodities assembled together into a house, sitting on a piece of dirt that can be depreciated, and so not only does it give you a lot of benefits like income and depreciation and potential equity growth through appreciation, but it's a hard asset. So it's an inflation hedge by default. And those are the three investment buckets that I look at the world at. So there's the precious metals, hard asset, there's the paper assets, and then there's real estate. You could throw a fourth bucket in there and call it commodities, which is like oil, gas, copper, all the base metals. So, but back to your question, I'm not sure if I'm answering your question, but yeah. We can go down the real estate road if you like.
Yeah, no, I'd like you to. And, it's important to know, obviously, real estate, that's a physical, tangible thing, right? Where, paper assets, that's been, mostly what I've been educated in most of my life, but it's intangible. A stock, a bond, index fund, an ETF, these securities, and we can kind of see that. We've seen it in the past go, poof, overnight when there's some kind of event or economic shock. We all know the story, Lehman Brothers going down, and then every major financial institution pretty much on the planet collapsing, and then having to funnel in trillions of dollars worth of bailouts to keep all these billionaires flying their Learjets. But with real estate, I mean, this is a tangible thing. A lot of people own at least their own home, or they would like to at some point in the future. Do you view a primary residence as an investment? I'm just curious because I hear some people tell me no. Some people say yeah. It's a lot of times it's people's one of their bigger assets. What's your view on that? And then maybe kind of take us down the road of real estate investing.
Okay, so is your principal residence an asset? Well, the question is who's it an asset to? I don't believe it to be an asset. I believe it's a liability to you as the homeowner. The reason is this: if you buy a house, you have a mortgage. Even if you own it free and clear, let's just talk about a mortgage for a second. You have a liability. If you think of your own personal balance sheet, you have to put that on your balance sheet as a liability because you have a mortgage loan on it. So what happens every month? You have to stroke a check to make a mortgage payment. Well, that comes out of your expense column on your personal profit and loss or income statement. So the fact that you own an asset doesn't mean that it's actually your asset. It's a liability to you. It's an asset to the bank who just gave you the mortgage for it. Now, what if you own that property free and clear? This is your home. Well, yes, you do own it, and yes, it is an asset. But again, every year you have to pay property taxes. If you don't, guess what? You can get that property taken away. You have to pay insurance. You have to pay maintenance and upkeep. So you still have liabilities. But the question is, how do you define an asset? And an asset is something that puts money in your pocket, not takes money out of your pocket. So if you think of it that way, if you look at your house as whether it's putting money in your pocket or taking money out of your pocket, it's actually taking money out of your pocket. Then some people might say, well, but my house is appreciating. I bought it for, $50,000 20 years ago, and today it's worth, $200,000 or whatever those numbers are. Well, true, it's appreciated, but you now need to step back and think about what I said 10 minutes ago about inflation. If you adjust that increase in the property's value against inflation, what you're going to find more often than not is over the long term, the average annual appreciation of any property over the long term would have kept up with the real rate of inflation. And so really you're not further ahead. All you've done, again, as a preservation of purchasing power, is you've just lived in an asset that has kept up with inflation. So what it was worth before is still what it's worth today. It's just in new dollar terms, real dollar terms, after inflation dollars. So that's the principal residence piece. But it works a little differently when you actually buy a piece of rental property or you build a portfolio, which is what we do with clients all the time. We help them assemble and build a portfolio around the country. And now those assets are true assets because you have a tenant that is living there. They're your customer. You're servicing them. They're paying you rent every month. That rent goes towards paying off your mortgage and the maintenance and upkeep for that property. So after you deduct all your expenses, what do you have left over? You have something left over, $200, $300, $400 per month per door. Well, that's positive cash flow. That's real spendable cash you can put in your pocket, reinvest, or go out and buy yourself a chocolate bar. Mm-hmm. But you got the income, and that's the definition of a, in my opinion, and many people's opinion, of what an asset should be. It should be generating income, and that's the beautiful thing about income real estate. Does that make sense?
No, it does. So you're primarily looking for cash flow, right? When you're looking at an investment property for acquisition, you're looking at buying an investment that can hopefully appreciate in the future, but you're principally looking for cash flow. Is that correct?
Cash flow is the name of the game. Cash flow is king. You know, if you think about it, if you talk to anybody who's got a job or they've got a source of income coming in, what happens when they stop running their business or they stop working? You know, you're trading more often than not time for dollars. If you get sick and you have to stop working, or you have a small business and you stop working that business, well, your income stops. So now you're completely dependent on that stream of cash in exchange for your time. When you can build a portfolio of assets that generate cash flow month after month, you have a stream of cash that will always be there. You know, some people refer to it as mailbox money or checks in the mail. That's the beautiful thing. And here's the cool thing. You know, we talk about being in the rat race or trying to get out of the rat race. Well, how do you know when you've gotten out of the rat race? The simple definition is this. Let's say you live a lifestyle where you have to spend $4,000 per month to cover your expenses, your car payment, your groceries, your insurance, and all that good stuff. Well, if you can acquire, let's say, 10 properties generating $400 a month, and we could play with the numbers, these are just variables, but when you have enough assets that are generating $4,000 a month or more, well, guess what? You can leave your job because you've got your nut covered. You've got your expenses covered. And that's the definition of financial freedom. That is what it means to be out of the rat race. And that's not hard to do. People do that all the time, every day of the year. And the easiest way to do that is through income real estate, rental real estate, turnkey, passive, cash flowing rental properties.
Yeah, I'm listening. You know, what you just said I thought was pretty cool. You said, you know, it's not hard to do that. And one of the easiest ways you can do that is start with, you know, investment properties and looking, you know, for cash flow and real estate and these kinds of things. We're in an interesting spot right now where I think people see inflation on the horizon, just to go back to that for a moment.
Sure.
But people perceive a lot of risk, like in the stock market, for example. I mean, we've seen a straight shot pretty much since, you know, the last financial collapse. There's, you know, and they're putting so much money into the system. A lot of people are taking that cash to the sidelines and they're sitting on it. But then they also know, and they're not getting a return on their investment, but they also know if inflation, you know, starts to pick up and they're slowly losing that way. Why do you think real estate is a good opportunity, you know, solution, so to speak, to that person that's sitting on cash? I know a lot of people like this. I mean, really, I was talking to a gentleman the other day, he's a very successful guy. He's like, Chris, I'm really just sitting on cash right now, probably for the next year or two. I'm just waiting to see what happens because he's scared. He looks at the stock market. He thinks things are over-levered again. We're pretty much back to where we were a few years back. A lot of people don't even know what to do with the money that they're sitting on. So why is real estate an attractive investment? How can it help protect against inflation and these kinds of things?
Well, before I can answer that, I have to comment on those people that are sitting on cash. That can be a dangerous place to be, and the reason for that is this: if you're sitting on cash, or you're saving cash, or you're stocking away money in the bank, or under your mattress, the problem with an inflationary environment is savers are losers, and I don't mean that in a personal sense. I mean that anybody trying to save cash today is losing out, because we're in an inflationary environment. So whether inflation is 1 or 2% or 4 or 5%, which a lot of people will argue it's even higher than that, but if you're in an inflationary environment, that means every year your savings are being eroded away. So savers are losers. Cash is a dangerous place to be in. Now, the only advantage to being in cash is if you need emergency funds, which I think people should sock that away, or if you expect to go into a deflationary environment sometime soon. I don't foresee that happening in the near term. But if we get into a deflationary environment, well, then the winners are people who are in a cash position, because your cash starts to become more valuable. The central banks around the world, and particularly the Fed, they don't want to see that happen. That is their worst nightmare. So question now is, what do you do with the cash you're sitting on? And by the way, this applies to people who are vested in the stock market. So they're not sitting in cash, they're sitting in equities, and now they have a position in the equities market. Well, again, that's a dangerous place to be, because we do have an overvalued, overheated stock market. So your question is, what do people do with real estate? If you're sitting on cash, you need to do something with it. And this is my opinion. So you can put yourself in an insurance defensive position with precious metals. You can put yourself into a speculative position by riding the market, believing that it'll continue to go up and up and up. Now, I don't believe that's the case anymore. Or third, you can put it to work. Well, you can put it to work in different ways. You can invest in mortgage notes, which is another thing that we do, just kind of a tangent type of thing that supplements our primary core business, which is investment real estate. But again, like I said at the beginning, I believe that income-producing real estate is the best asset class. It is the most historically proven wealth preservation asset, as well as wealth creation asset. So think about this. I'm just going to take $20,000 as an example. If you're sitting on $20,000, or you got $20,000 in the stock market, and you could redeploy it and put it to better use, you can use that $20,000 to pick up, and I'm just rounding numbers here for simplicity, but you can acquire a 3-bedroom, 2-bath home in many of the markets that we operate in that are around $90,000, $100,000, $110,000. That's about the median of what we're selling right now. So that $20,000 becomes a down payment. So now you've acquired a $100,000 asset with only 20% down. The banks and lenders out there are tripping over themselves to lend you the funds to purchase the rest of that acquisition, which is 80%. So guess what? You own this house. You own 100% of it. You have 100% of the income, 100% of the depreciation, 100% of the appreciation and the equity pay down. You've only had to put 20% down. It's an inflation hedge. It generates monthly cash flow. And so even if we come into a deflationary environment, or we see another recession, which is inevitable, I think we're overdue for a recessionary period, but you just weather it out, because what do people need? They need food, shelter, and clothing. And those are really the places, food, shelter, and food, shelter. Well, food and shelter are really the two best places to be investing today. And if you follow trend forecasters like Gerald Celente, for example, he has flat out said just 2-3 months ago that two of the best places you could be putting your investment capital today are water and food. But he qualified that by saying the third best place is real estate. So anyway, I'm rambling on, but you can see my passion when it comes to why real estate makes so much sense, especially in the uncertain inflationary environment that we sit in today.
So what happens, in an inflationary environment? It's tough to see deflation. Sometimes when it's tough to see something, that's when it rears its ugly head. But it's tough to see it with the stimulative policies of the Fed, which you're totally right. I mean, what does the Federal Reserve fear the most? What do our government officials fear the most? Well, they fear a deflationary environment, right? That's why they're doing everything in their power to just, pump all this money into the economy. It's on central banks' balance sheets and, of course, in the hands of Wall Street. With, inflation, how does that work with, a mortgage, for example? So obviously, if there is inflation, chances are there'll be appreciation in the home, your investment, but it also makes the debt cheaper to service, if I'm correct. Is that right?
Absolutely. A great point, and I'm glad you brought that up, because most people overlook this amazing fringe benefit that's kind of baked into the cake when you're buying real estate and you're leveraging it intelligently. This is good debt, not bad debt. We're not going on vacations here, but when you're acquiring real estate and you're leveraging your investment capital to acquire more property, you've got mortgage financing placed on those properties that are fixed. Well, we encourage investors to do 30-year fixed rate mortgages, but there are other options out there. But think about this. If a lender gives you a 30-year fixed rate mortgage that your tenant is paying off for you over time, and you can accelerate that if you want, but your tenant's paying off your mortgage for you. So they're, in effect, buying your house for you. They're buying your properties for you. But the interest rate is fixed. And so if we see 2 or 3 or 4% inflation this year and another 2 to 4% inflation next year and so on, the bank doesn't come back to you and say, well, hey, the purchasing power of the dollar has gone down and we're in inflationary times and we need to adjust your mortgage payment to keep up with inflation. No, they don't do that. They can't do that. You've locked in to a particular rate of interest. The bank is banking on you to pay off or refinance that mortgage in 5 to 7 years, which is about the national average as far as when mortgages are paid off with homeowners. Investment properties are longer than that.
5 to 7 years, you said, on primary?
5 to 7 years, yeah. The typical homeowner will move every 5 to 7 years.
Oh,
and so what they're doing is they're paying off that existing mortgage and getting a new mortgage on wherever they're moving to. Mm-hmm. But the key point here is this: you've got a mortgage on your rental properties that are at a fixed rate, and it doesn't adjust for inflation. So that means every year you're actually paying off that mortgage with cheaper and cheaper dollars. You're paying it with inflation adjusted dollars. So I assume you have a smart audience. I assume most of them understand what I'm saying. Mm-hmm. But just to make the point extra clear, is that mortgage is becoming less and less expensive to service each and every year. If you talk to your parents or someone who bought a house 20, 30 years ago, maybe back then they were paying $300-400 a month on their mortgage, and they thought, well, geez, that's we're taking a little bit of a leap here. That's an expensive monthly debt to service every month. But 10, 20 years later, you look back and you think, gosh, that $400 was nothing. Like today, we're $400 is like a car payment. It's nothing. So
sure,
you got to think about it that way.
Yeah, and it's interesting too. And obviously, the advantage is you're locking in at 0% essentially. Mortgages, I haven't seen what the latest numbers are, but I'm guessing 4.5% or something like that maybe on a 30-year mortgage, at least if it was a primary residence. Might be a little different with investment properties, but you're essentially locking in at rates that we've never seen before almost ever, right? I mean, I remember talking to my grandfather when he was alive. I think he had like a 30-year treasury bond or something that paid him like 16%. Right. Or something like that, and a mortgage that was like 13%, and he thought that was getting a deal, and now you can take one out for 4.
Yeah, absolutely. I mean, like I said, we're at historically low rate mortgage rates and interest rates, but yeah, I mean, this is super cheap money. So, given what I've said so far, the question is, if you can get this ultra low cheap money to acquire income producing assets, how much of it do you want? Sit back and ask yourself that question. How much of it do you want? I'd say, back the truck up. Let's get as much of it as we possibly can, because in 2 years from now, 3 years from now, we may not be in this position. Interest rates may be higher. They need to be higher. I mean, if we had a true free market, all these rates would be higher. They're artificially suppressed and they're low. So we as investors and consumers should take advantage of it. Let's stock up on as much as we possibly can and take advantage of the system. You can't change the system, but let's take advantage of it. You got to play your cards, the cards you're dealt, properly.
Yeah, absolutely. Well, nobody's going to take care of you but yourself, right? I mean, you can't rely on the government. You can't, rely on Hillary Clinton or Donald Trump, to make sure that you have a bright future, right? And that you can provide for yourself and your family. So, looking at individual property, I mean, common objection I'll get, well, Christopher, I'm not a millionaire, so how am I going to get started, investing in real estate? So maybe kind of walk us through that. Who you work with, like what's the typical? Is it people just getting started investing in real estate, or maybe you're working with both, sophisticated investors, maybe people new to it, and kind of explain that a little bit. And how much do you need? You said 20% down roughly on these properties. Is that typically what people are doing to get started? Like, let's say you wanted to buy your first home. How would you get started today? How much money would you need to do that realistically?
We have a very diverse clientele. Most of our clients are from the United States, but we have clients from Canada, the UK, Australia, different parts of the world. Our youngest and most newbie type of investor is, in the 18 to 20-year-old range. They've saved enough capital to buy their first property, and they're getting started, but they know what they want to do, and they're just laying that first brick in the wall, and they're going to build it up. On the far end of the other end of the spectrum, there, we have investors that are literally sitting on millions of dollars. They've got millions of dollars both in cash and parked in places like the stock market, which they know that they need to move away from. And so we work with everybody and we cater to everybody. Everybody has their own investment goals. Those ultimately get broken down into criteria, and that lays the foundation and the framework for what they're going to acquire and what we're going to help them acquire. So it's a completely turnkey, simplified, passive real estate investing model. As far as down payments, the cheapest money out there is, of course, the government subsidized money, which is Fannie Mae, Freddie Mac. These are called conventional loans. It's conventional financing, and it's, again, artificially low, but it's cheap money that you have access to. So if you're buying an income property, you can pick up these 30-year fixed rate mortgages as an investor for about 4.5% to 5%. Plus or minus, but it fluctuates, but It's under 5% typically. So those are super low rates. Now, again, if you can't compare it to your principal residence, which is like 3-point-something%. But 20% is the starting point, and if you've got the capital, great, you're in a good position. If you don't have the capital, you need to figure out how to increase your income and save at the same time, so you can build up deployable investment capital where you can start putting it out there wherever you want to put it. Those buckets we talked about before. Not everybody can do it, at least not today. But if you're sitting on, 5 figures of capital, 6 figures or more, you're in a great position to make a strategic decision to better yourself in the years to come, not just for you, but your family, your heirs, your whole estate.
Now, a lot of people will say, okay, with real estate, one of the negatives is management, right? Getting tenants into the property, managing those tenants. You've got to be a landlord, and then people start thinking all that stuff through, and they're like, I don't know if I really want to do this. How does your company kind of address that? And maybe kind of talk about that a little bit.
I call property management the world's most thankless job.
I've heard that.
It's I wouldn't want to do it. I've done it. I've managed my own properties, but I feel my time is worth more than the 8 to 10% that I'm paying my property managers to manage my portfolio of properties. I'd rather spend time with my family and find more deals and do more business. So property management is critically important. I half jokingly say you live and die by your property manager. And that's just to emphasize, it's tongue in cheek, but it's just to emphasize the importance of management and why it's so important. We operate in about 10 or 12 different markets. In each of those markets, we have turnkey, fully renovated and new construction properties. Each one of those properties are already tied to a professional full-service property management company. those management companies, their job is to manage that asset. And I call it that specifically. I didn't say property. I said it's an asset. It's your asset. So their job, you're hiring them to do a job for you. They're a vendor to you. And they are there to keep an eye on your asset, work with the tenants, collect the rents, send you the rents, take care of any maintenance and repair issues that come up over the years, and really communicate with you on an ongoing basis as to what is going on. And usually that's done through an online system, and there's monthly statements and monthly deposits into your bank account. So you need to have a relationship with your property manager. We put our clients in touch with the management companies that we work with so they can get to know them and get a warm, fuzzy feeling in their belly. At the end of the day, these are your properties. You can have anybody manage them that you choose, including yourself. My suggestion to virtually any investor out there, if you're building a portfolio, unless you want to manage it yourself and you know what you're doing and you're professional at it, let someone else do it. It's well worth the money. You know, if you're sitting on hundreds of thousands or millions of dollars and you want to play the stock market or you want to hire a financial advisor, guess what? They're charging you a fee too. There's a fee everywhere, no matter what you invest in. So management is, money well spent. I don't know if I answered your question, yeah. Christopher.
No, you did. You did.
Okay, good.
And that's a common thing that I hear a lot, from people, which, like you said too, time is really our greatest asset. And a lot of people would rather spend that time with their kids and, with their wife or their husband or whatever, or, pursuing other interests. Now, in terms of opportunities, where do you see some of the best markets today? Where do the opportunities lie at this given point of time in your expertise?
Before I answer that, can I touch on the time thing real quick?
Absolutely.
Okay, so the reason most of the clients that come to us is because of the time factor. They don't want to be an active real estate investor rolling up their sleeves and having to do the work themselves. In other words, decide on the market to be investing in, finding a property on the MLS or acquiring a property from an auction. They don't want to do that due diligence and all that work in acquiring, scoping the property, renovating it, managing their general contractor, bringing on a property manager, and coordinating all that stuff. It's a very active role. There's two types of real estate investors, active and passive. We cater to the passive investor because they put a value on their time. Now, they may not have the knowledge, they may not have the experience, and they may not have the time. Those are three key things as to why investors go the passive real estate investing route versus the active real estate investing route. There's nothing wrong with either one of them. They're both great. It's just how much time do you have, how much experience and knowledge, and how much heavy lifting do you want to do? And so just so it's clear to your audience, we focus on investors that don't want to spend all that active effort and want to take a more passive route.
Yeah, well, it's you can't be an expert, in everything, right?
No, exactly.
Some people try to do it, but I've got news for you. You're not going to do that good of a job. I mean, I look at myself, what am I doing every single day? I'm here in studio. We're, investigating stories. I'm putting out reports. I mean, it's all I do. It's all we do here. I'm not out looking at real estate investments like you are. So, there's so much truth to that. I believe.
Agreed. So, as far as markets go, as I mentioned, we're in about 10 or 12 markets. Some of them come and go. We kind of change them around from time to time. We're looking at bringing on a couple new markets here soon. But the markets that we are focused on and have been focused on are Atlanta, Birmingham, Columbia, Dallas, Houston, San Antonio, Jacksonville, Kansas City, Indianapolis, Memphis, Salt Lake City, and I'm missing one. We're looking at a couple of markets right now, like the greater Chicagoland area, Philadelphia. Now, what makes a good market? I'll give you a simple answer. At the end of the day, for someone to pay their bills and pay their rent, what do they need? They need a job. So at the core of it all is you need a market that has a healthy economy. And so at the root of that is jobs and job growth. If you have jobs and job growth, guess what? You're going to have a stable or growing population. Typically, you'll see in-migration from other areas. The Texas markets have been a poster child for this. Yes, it's a business friendly state. It's a red state, but they've been drawing people in from New York to California for over a decade. In fact, there are websites literally showing all the companies that have been moving out of the state of California to other states, and the number one state has been Texas. Of course, Nevada, Arizona have been states like that. Phoenix has been a recipient of a lot of California people in business. So you want a state that is, that has jobs and job growth. It has low taxes or no taxes. It's business friendly. It's not overregulated, and that is part of what makes a good market. The other thing that makes a good market are the fundamentals of that market. This plays into the economics. Does it have a broad economic base? Meaning that there's sectors, there's finance, there's healthcare, you've got construction, manufacturing, all kinds of things. The one-trick pony markets, like let's say North Dakota, that was booming when we had high oil prices, and you couldn't find a place to live. You literally had to prop up a tent and live in your tent if you could even do that. There was no supply of real estate. Then they built. They didn't quite overbuild that market. What happened is oil prices dropped into the 40s, and they capped the wells, and now there were no jobs. And so if there's no jobs, what's the reason to stay there? So people left. And so you don't want to be in a market like that. And then third, you want a healthy housing market, but more importantly, you want an affordable housing market where the rent-to-value ratio makes sense. What do I mean by that? Let's say you have that $100,000 property I was talking about before. If you can buy that $100,000 property and rent it for $900, $1,000, or $1,100 per month, you've got the starting point. That's the litmus test to look further and see if it makes sense to invest in that market, and then you start picking neighborhoods. That's about a 1% rent-to-value ratio, a $100,000 house renting for $1,000. You can't do that in San Francisco. You can't do that in New York. You can't do that in most places. If you go to San Francisco, I mean, talk about an overpriced, inflated market. You're talking about condos that have finally reached $1 million. That doesn't make any sense. But even in Southern California, where I live here, I can find so-called "quote unquote" good deals here for $400,000 to $500,000. But here's the problem: I'm going to be renting that thing for about $2,000, $2,200 a month. Those numbers don't make sense. There's no cash flow, and my rate of return is pathetic. It's low single digit. So if I'm going to put 20% down on a $500,000 home, that's $100,000. Well, guess what? That $100,000, I can go to Indianapolis or Kansas City or some of the other markets we operate in and take that $100,000 and acquire 4 to 5 of those $100,000 properties, have a bigger portfolio, lower downside risk, and have much higher cash flow and a much higher rate of return. It's typically a double-digit cash-on-cash return.
Yeah, that's an excellent point. You've got diversification of the properties, and you could even have diversification of the market too, right? It could be in a few different locations as well. Yeah, it's amazing how sky high the prices are in places like Silicon Valley or Southern California. Where
unbelievable.
I've got a friend over there right now, and they texted me earlier this morning. He was like, "Hey, Chris, I'm in California. Can I borrow $3 million? There's a dump by the freeway that I'm interested in."
No.
But, it's like, well, first of all, yeah, you're going to have to look for that money elsewhere. But
Well, think about this, Christopher. Not to cut you off, but if anybody's in those markets listening to this, they're in any of the coastal markets of the United States, or some of the areas like surrounding areas around Washington, D.C., which is got 6 out of the 10 most overpriced, expensive counties in the country. But if you're in an area where you can't find properties in good neighborhoods that can come close to that 1% rent-to-value ratio, and this is easy to find out. I mean, it'll only take you 5 minutes to do this. But I challenge you, go out and do that. Look at your local market if you're looking to invest in real estate. See if you can acquire affordably priced properties in good neighborhoods that meet that 1% rent-to-value ratio, or come close. If you can't, then what you should be thinking about is 2 things. One, let's start looking at some other markets where it makes more sense to invest and where I can leverage my investment capital and go much further, get a higher rate of return, because we're all after yield. And we're in a world right now where people are starved for yield. They're chasing after yield. That's number one. Number two, if you're already invested in a market or your local market, that's an overpriced market, or its yield curve has gone past its prime, where now you're seeing that low rent to value ratio. As a smart investor, what you should be thinking out of is taking that equity out of that market and redeploying it in other markets where you can increase your rate of return and decrease your exposure, your downside risk. That's a smart play, because you can do that tax-free through a 1031 exchange. So you can get out of riskier markets, get into better markets with higher rates of return. I really challenge your listeners to think about that.
Mm-hmm. What typically are you finding is the long-term goal? I mean, I think I know the answer. I'm just curious to what it is. But people accumulating, building a diversified portfolio of rental properties. Are most people holding them just kind of forever? Just building a cash flow portfolio. I mean, it can even transfer hands multi-generationally. Are people, selling properties? Like what do they do long term? What do you think the objective is for most people?
Most people want to build a portfolio to the point where they get to their target number, their freedom number, or their get out of the rat race number. They may have an income goal of $5,000, $10,000, $25,000. We have investors that have monthly income goals of $50,000 a month. Now that's a fairly sizable portfolio, and you build it up. Like in Monopoly, you have 4 greenhouses, 1 red hotel, if I remember the colors right. Mm-hmm. You continue to build it up. So the idea is you want to build a portfolio. You're not a trader. You're not a flipper. You are a long-term buy and hold investor. So you want to build a portfolio. You want to take that cash flow, benefit from it, write off the depreciation to lower your taxes. You want your wealth to increase through the amortization of that loan. Remember, it's your tenant that's paying it off, not you. Your tenant's paying down that mortgage. And then over time, you'll have appreciation. So that increases your net worth. It's your personal balance sheet that's growing. But the question is, why would you want to sell it? Here's your options. One, you keep it and live a lifestyle that you want to live. Okay, this is your financial freedom and your personal freedom. Okay, you build a lifestyle. 2, if you have heirs, children, you may want to pass it on or will it to them. You put that in your estate, and then after, when you do pass, they can inherit that, or you can pass that on down to their grandchildren. There's a lot of things you could do there. But I talk to very few people that really want to sell their properties. The question is, why do you want to sell it? The only reason to sell it is if you are in financial trouble and you actually need to pay like a large medical bill or something, and you need to tap into that equity and sell it to take care of a unfortunate situation. Otherwise, the smart thing to do is to build up your portfolio, build up your net worth. And if you play it right, and this is one of the strategies we share with clients that we work with, is how to leverage the growth in your equity to acquire and accelerate your acquisition of more property. So then you just magnify your net worth and you magnify your cash flow. So
I thought it was really
long term.
Yeah, absolutely. I thought it was really cool what you said about your freedom number, which I think, and I'd encourage everyone tuning in. I mean, whether or not you're in college or you just got out, or you're a very successful, businessman and you're sitting on a pile of money. I mean, that to me is exciting. I mean, what is your freedom number? And kind of just put that out to the audience right now too. I mean, no matter if it's $5,000 a month, $10,000, $25,000, maybe it's $50,000 a month, but you can kind of build your entire game plan around that, and then look at opportunities. How am I going to get there? Structure a strategy around achieving that cash flow to live the life, which is pretty much everything we do here. At AMTV, it's about freedom and liberty, and taking life by the balls a little bit too, and not depending on the government. Right? You got to depend on yourself.
Oh man, you can't live depending on the government. Unfortunately, so many people do. My mother-in-law is falls into that category. She's on a fixed income, as hundreds of thousands of people are. And guess what? Fixed income is exactly that. It's fixed. It doesn't go up, at the pace of real inflation. So it might go up a little bit every year, depending on what you're involved in. But you're stuck. You're trapped. You've got your hands tied behind your back. You can't just, unless you start a business, you really can't increase your income. So there's a concept I really love, Christopher. It's I think, I think our economic system has a lot of problems. I think the political system is broken. I think there's a lot of problems in the world and a lot of issues that we can't fix, or at least we can't fix right away. And I think you would agree with me, and most of your listeners would agree with me. We all are hopeful. We want to change the system. We want to bring in the right people. But at the end of the day, we can't fix this on our own. And maybe in time we can, but we can't fix it on our own. But what we don't have control over it. That's the key thing. There's no control. But what do you have control over? Well, you have control over a concept I like to refer to as your own local economy, your personal economy. You have control over that. Guess what? Hillary can get elected, as I think she might. Taxes will go up again. We will be in a country that has some of the highest tax rates in the world, especially corporate taxes. Well, you can't get around that. So what do? Well, you do the best that you can. You play by their rules. You work within their system. You play by their tax code and their playbook. And you acquire assets that they want you to acquire and that they encourage you to acquire. And real estate happens to be one of those. If you look at all the tax deductions and the tax benefits available to you as an individual, and more specifically you as an investor, they're heavily skewed towards oil, gas, and real estate. So if you know the rules and you can take advantage of them, why not take advantage of them and play with them? Why not put them to work for you instead of complaining about the system and waiting for things to change? Well, you're going to wait for a long time. I think you should just invest wisely. Get yourself all the G's. Guns, gold, grub, ground, which is land, real estate. Build it up, protect you and your family, prepare for, hard times so you can weather the storm. But while you're doing that, build up your portfolio, create some income, because guess what? A year from now, you may not have a job. We could be in a recession again, and you'll be stuck in a situation where you're going to have to rely on, what you have stored for food, savings, and your investments.
Yeah, it's all about empowerment, and like you said too, I thought it really stood out. They want you to acquire real estate. They've created an environment for it. So learn the rules, understand the game, play the game of life. It's kind of like that, the game
exactly
of Monopoly.
Exactly what it is.
Play your game of life, have your vision. Put it to paper, write it down. There's something very visceral about it. So we're talking about the freedom number. Write down what your freedom number is, what your goals are, what your vision for the future is, and take action. Marco, thanks so much for coming on the show today. How can our listeners learn more, and where can they find you?
I'll just throw out two websites because everything is there. Our core business, which is the real estate website, which has tons of free information, and we have a free report. It's kind of a mini ebook called The Ultimate Guide to Passive Real Estate Investing. All that is found on noradarealestate.com. Then that's spelled Norada, noradarealestate.com. And then as an adjunct to that, kind of like a free information, free educational type of content, I've started a podcast over a year ago called Passive Real Estate Investing, and obviously the domain name is passiverealestateinvesting.com. So that's a free weekly podcast that is literally meant to educate people on what it is, how to get involved, what you need to know, how to get started, yada, yada.
Awesome. Well, Marco, thank you so much. We'll definitely have you back on the program sometime soon.
I appreciate it, Christopher. Thank you for your time today. It's been fun.
You bet.